Hi, this is your interest rate watch for Thursday, September the 16th. You know, in the media today, the Labor Department reported the jobless claims 450,000, which is below the 460,000 expected. And when you used to hear the saying, no news is good news, well, so-so news is good news right now when it comes to Wall Street. These numbers definitely are not impressive. However, it is being received at Wall Street as positive signs, and they're rallying with it. That always does put a hurt on the mortgage side. So for the homeowners out there, interest rates are starting to tick up again. And again, these aren't signs that interest rates are going to go through the roof. We still have a lot of technical signs that are coming out over the next 3 months, going into the holiday seasons, that could still really put the damper on what interest rates are going to do as far as moving higher. We still believe that there's going to be the lulls, and those are going to be the key times to take advantage of those opportunities. The biggest thing right now is still, yesterday we touched on Goldman Sachs putting out speculations of what the Federal Reserve could potentially do with this new $1 trillion purchase program. And then also now in the media today with Timothy Geithner this morning touching on what's going on with China. Keep in mind how this all is relative with China and the United States relationship. China is the biggest investor, and they are funding our national debt as far as buying the bonds. And when they do that, they keep their yuan, which is their dollar, so to speak, in China, extremely low. They offset it. So the yuan should technically be higher, but what they're doing is they keep buying the U.S. debt that we need someone to buy to help us stay in this recovery mode, because the government is putting out all this money to try to get the economy going. And you know, there's always different views on that, but they're trying to keep the economy going. And what that's doing is keeping our bond market low. If you take out China as the main investor, then what happens is the yields on those bonds have to go up. In a long story short, when those yields go up, the reason that they're doing that is to attract more investors to basically finance our debt. And in doing so, the mortgage market is right there with it. For the homeowners out there, when the yields on those bonds do start to go up, interest rates are relative to the penny. So when those yields go up, interest rates are going to move up. And that's the biggest thing that we're a little concerned on with what's our relationship with China, how the government's going to play that out, and what's going on in November, going into December and January and February with Fannie Mae and Freddie Mac potentially being released back to the private sector. Could the funding from this $1 trillion be putting out there if that's what it's going to do? So the key thing right now, again, we're going to have peaks and valleys in the market. And it's a day-to-day timing right now. Sometimes we're getting intraday reprices for the worst as far as interest rates moving up because of the economic news coming out. So this is the biggest difference. Bottom line is, if you have a loan today that you could do at 4.5 with no closing cost, hypothetically, right? And tomorrow we hear more economic data. Then all of a sudden that 4.5 might be where you're paying some closing costs now. We go into Monday, and all of a sudden it still might be 4.5 as interest rate, but now you're paying all closing costs. That is the biggest thing that we're seeing on a daily basis. And that's why timing is so crucial. Working with the right loan officer that can provide you the right education, that has this type of information at their fingertips, and is constantly keeping track of it. That is the biggest difference in creating thousands of dollars in closing cost savings, or ultimately having the lower interest rate and still having the savings resulting in lower closing costs. We will definitely like to be that loan officer to assist you with those services. So definitely keep us in mind. Make sure to follow us on our Twitter and Facebook page, and we'll be back in touch tomorrow.